to whom you are talking, you will find that all regulator is working out, and there is an instruction from the government side that you have to change, simplify, and do the ease of doing business. And that's why so many committees are working. Me and Ankita as part of some of the committees, and everybody is pushing this, that how they should reduce compliances. No doubt in this process, you have to do the sanctity check of the compliances, whether it's reducing or increasing. But it is the position today that all departments are working, especially if I can say the Niti Aayog is also working on this issue, and their working is totally different because they can control and they can command everybody. If some reforms has to take place in Companies Act, then the Ministry of Corporate Affairs cannot change income tax, cannot change GST, cannot change various other things which is connected to other department. But Niti Aayog can do this. So they have a larger view, and there are so many chambers, professionals, institution, they are the member, and government is working out. Me and Ankita attending meeting on behalf of SOCHM, and we are finding that they want to do hellbound to reduce compliances and make it simplified. And that's why so many changes which are taking place. We are realizing today that why this was the thing earlier, and why people have not done. So friends, today's topic is very topical and immediate. And despite of the holiday, we have decided to have this seminar on this Decoding of Corporate Law, Amendment Bill 2026, Key Reforms and Industry Impact. No doubt this bill is going to Parliament Committee, and it will take 5 to 6 months. But what is the basic purpose? That we should, through this program, we should communicate to the industry that this is happening, and whatever suggestions you have, something which is missing, we can compile it and give it to the Parliament Committee also, or the government in this way. So friends, this bill which is there, it is representing progressive step in India, and they are building upon earlier amendments. But now these amendments are totally different. They are putting more, enhancing transparency, accountability, and ease of doing business. But now the one thing is, if you see this, it is happening. They are doing compliances, reduction is taking place, but certain things, they are putting all efforts that it should more accountable. They are this particular committee, this particular amendment which is there, it is based on the Company Law Committee 2022, and they have done their multiple consultation, and then it has come out with this. So friends, these proposed amendments seek various things which are making life easy to professional as well as the corporate. So decriminalization is one, and the penalty clause is also, that is another aspects. And I was reading that per day penalty, they are restricting now a particular amount. And we have seen so many cases where per day penalty, because of the ignorance, has becoming lakhs and lakhs rupees, and it was unviable to manage this. So flexibility of business, particularly for startup, small scale, small companies, definition has changed, LLP, and the entities operating under International Financial Service Center. That is the biggest change which this particular law amendment is bringing out, because Gift City is there, but there is some disconnect. So they are introducing various new things which we will discuss today. They are bringing out various changes in National Company Law Tribunal, NFRA, which is making a statutory body now, like a SEBI and RBI, this type of thing they are doing. And the purpose is that how they can make it efficient, robust governance system in the country. So friends, this webinar is aimed to provide policy-oriented and practical decoding of the bill by analyzing its key proposal, underlying intent, and potential impact on corporate, professional, and investor. The session will help participants understand how the reforms are taking place and how the intricacy of this law or changes will impact the industry. And that was their demand. So it is a very important point that we are shifting toward not the making law, but facilitating business, digitalization, and making a globally aligned economic ecosystem. So for this, you have seen the galaxy of speakers today, and I will introduce one by one. We have Amit Gupta, who is a practicing company secretary, insolvency professional. Then we have Mr. G.P. Madan, founder, managing partner, Madan Law Office, and looking after the NCLT and insolvency work. Then we have Narayan Shankar, former executive vice president and company secretary of Mahindra and Mahindra, and he's was a committee member of the ESOP of SEBI and various committee of government on RPT. Then we have Anjali Agrawal, partner and head capital market service. Anjali looks after various capital market related thing as well as the Gift City. Ankit is the head corporate affairs and compliance corporate professional, and Ankit is a part of various committees also government and through from the SOCM side. So he knows the how things are changing and what will be the impact of this. And we have Manoj Kumar, partner, M&A investment banking corporate professional, and Manoj will tell us about the changes taking place. One of the biggest change in this particular bill is M&A, and it is given new boost. Then we have a Mohini Bashne. She is the head of ESOP and Insider Law Service, and Mohini will cover the ESOP related thing. So friends, the structure is very simple. What we are doing, that the M&A, Gift City, and then ESOP. These are the topics. Manoj will cover M&A, Anjali will cover Gift City, and Mohini will cover ESOP. And after the each point, the expert which are sitting, Madan, Amit, Narayan Shankar, or any other person sitting here, they will give their comments on this. And then I will take up Ankit's point of view, that entire other thing, decriminalization, other definition change, other than these things, Ankit will cover, and Madan, Narayan, and Amit will solve the problem. So Ankit will give the structure that what was the law and what has changed and how this will change. So I will ask question or Ankit will pose some questions. So our other speakers will give, because last portion of Ankit has a multiple topics. So I have kept it last. Initially Manoj and Anjali and Mohini will cover it. So friends, before starting and giving to the to other speakers, I think there are 4 layers. One is economic impact. Second is corporate behavior shift. Next is professional transformation. And then fourth is Indian global positioning. So if I can summarize the entire changes in this. So first is the key policy focus area. What is key, which is affecting economy? Number one, decriminalization. So promoter is it trust-based, business-friendly regulatory regime. That is one. So we are shifting from control-based to trust-based. This is one part. And this will directly impact our GDP velocity and the shifting business and the corporate. Then explosion of formal economy. Now it is, if you remember, when government has started LLP, the purpose was that formal economy should be stronger and informal companies and partnerships should convert into LLP. But it has not taken place because of the various issue of compliances. Now their efforts is clearly visible now. They want to ease for a startup, small company, and they have changed the definition of a small company, also making it bigger than LLPs. So they want to reduce this. So the future impact will be very clear. Mass formalization of informal sector. If the compliance is less, compliance is not criminal, not penalty like this, then people will come and they will join, because there is a continuation succession and the your entity is different and the bank is also insisting, that will take new shape. growth in tax base, credit base, and the investment readiness will also be there, and more company will see. So I just think, it is my calculation, India will see next wave of 1 lakh plus growth ready company, which will uh, more go to the loan side, which will raise fund, which will raise private equity, which will go to the IPO. So the entire sector will move on. Then capital market deepening. By doing this, recognition of this ESOP, RSU, and SAR, which was earlier, it was confusing. SEBI was accepting, but company law has some issue that will change. Flexible capital structures they are suggesting. That is also like buyback, another thing they are introducing, that you can bring out number of times. Then IFSC ecosystem, that is also. So in my opinion, these changes will bring out the company will move on IPO, raise global capital also, because now they are connecting to Gift City. And this will lead to expansion of equity culture in India, high retail participation, and a stronger valuation ecosystem that will come in India. Then fourth and last point is digital governance, real-time compliance economy that will come. So hybrid meetings, electronic records, digitization, and it will impact future by compliance will shift from periodic to continuous, and online system will be there. You can do this, and data-driven governance will emerge, and future will be real-time filing will take place and real-time updation will take place. Integrated MCA SEBI tax system, that is also in the same direction. No, it is not mentioned, but it is the behind the scene, it is reflecting. AI-driven compliance monitor will also take place. So you can just can't do something here and something there. It is everybody is watching. Then friends, these are the basic point, but Indian market will compare with the global corporate hub. Indian corporate will also join global market, and they will identify. One is IFSC, global structure flexibility is provided. So Indian competing with India will compete with Singapore, Dubai, and London on this. And then we have a global structure and jurisdiction, capital raising destination. That is another aspect. And if you see this, when LG has come out issues, so many foreign companies, earlier we were going out of India, but now that these foreign companies, they are not raising money from their own country, they are raising money in India, and this is the strength of the country which will take place, and capital raising destination India will become. Then another important thing which this bill is providing, and that is creating investor confidence. One is they are strengthening the NAFRA and NCLT. And because of this, audit discipline will increase, better governance credibility will be there, and increase the result. What will be the result? Result will more FDI, because people will have more, they will realize that things can take place, and long-term institutional capital can build. Friends, corporate behavior transformation will also take place. So earliest mindset was compliance is equal to burden. Future mindset, governance will value creator. That is one biggest change will come, and it is already reflecting in the minds of everyone. Sometimes people are not violating law, but they are compelled to do because of certain reason that they have no other solution. So they violate intentionally or unintentionally because of this. But now when things will be easy, decriminalization will not be there, then people will not do violation, they will openly come out. So governance will be value creator, that is one part. And the company will move from transparency as a strategy and governance as a valuation driver, that will take place. Friends, now everything will change, but in this particular bill, the role of professional has changed drastically. And in making NAFRA a strong organization, you will find so many changes. So this is why where all professionals should realize the future of professional will not be compliance executor. It is obsolete word now, because they are reducing compliance, they are reducing various things. So strategic advisor is essential now. So all chartered accountant, company secretary, these who are depending upon filing and doing normal thing, they have to work out the governance architecture, architect they have to become, structuring expert they have to become, capital market advisor they have to become, and technology enabled consultant should be there. The Vision 2030 of India, if implemented effectively, these reforms will not just amend law, they will redefine how Indian business are created, governed, and scaled. This bill is not a legal amendment. It's a blueprint for Indian transformation into a global competition, trust-driven digital economy, corporate economy. That is the change. As a professional, we must not see the reforms as a compliance change, but as an opportunity to reimagine our role as a nation building, an institutional creator, and the value creator for the companies. In my opinion, the significant improvement in ease of doing business will take place, reduced compliances and litigation will take place, a stronger corporate governance and audit framework will change, better alignment with global practices will do, enhanced support of startup, MNC and IFSC ecosystem. So startup or MNC, if you can bring out them in your radar or in your fold, then a country will automatically develop. But dil mange more, that is one concept which is always there. So many things has covered, but something has not covered. Like definition and drafting correction, like warrant in security, that definition is not there. Definition of wholly owned subsidiary company, that is also spec framework, not allowed special purpose acquisition companies, where SEBI has talked, but it is happening indirectly. We have not come. Permanent digital governance reform. There are so many things in this, like they are partly covered. We see hybrid meeting allowed, but now they are after 3 years, one AGM you have to do physically. I don't know why. Permanent removal of physical dispatch of annual report, they have not stopped. Corporate governance strengthening, they have done, but not covered is mandatory director training, because they are saying without director's knowledge. Concept of lead independent director, cap on number of independent directorship, rationalization of remuneration disclosure, merger. They have done so many changes, welcome changes, but merger of LLP and company is not there. Manoj will explain. And dispensing with shareholders meeting like creditors is not there. NCLT jurisdiction infrastructure reforms, Madan will highlight on this. Completely missing. Increase in NCLT benches, dedicated benches for IBC, M&A matter, fixed timeline for disposal, that has not come out. MCA system and practical compliance issue, not covered. Waiver of penalty due to MCA portal glitches, real-time grievances handling system. So these are the things which are there. And other thing, what is the contradiction, what is missing, that other expert will discuss. So what I will do this, I will start with Anjali, because small chapters we will finish. Anjali, you please tell us what Gift City changes are there. Friends, we have invited Pradeep Ramakrishnan, ED, for this program, but the problem is, when any bill is referred to the Parliament committee, then the government officer can't speak on this, okay, on particular topic. So Pradeep has told me that on next webinar after the this is our next webinar is on 10th, because 3rd is holiday. So he will take up the entire topic on Gift City, and we are inviting him for this program. That's why his name was there, but this technical issue was there. So I have requested him, okay, we'll take up your knowledge and wisdom in the next program. So Anjali, you just do. So after Anjali, anybody wants to give any comments on this Gift City changes, just raise your hand. I will ask, and then I will move to the M&A, then I will move to the ESOP, and then Narayan, Amit, or Madan, or Ankit, anybody, they can just add, but repetition should not be there, because we have to cover, and there's so many questions are coming. Okay, over to you, Anjali, for this particular Gift City changes.
Thank you so much, sir. Thank you for giving such a good detailed preliminary for the proposed changes which are there in this bill. And when we talk about the proposed changes, as Pavan sir said, the changes are very progressive in nature and target to facilitate the Indian companies doing better business and accessing more capital, not just from Indian domain, but also from the foreign domain, foreign locations. So in this aspect, the Gift City is the newest and the best example which Prime Minister Modi has proposed to the country as a whole. Next. So when we talk about gift, what we need to understand is what exactly is gift. Many of the important changes have been proposed when we talk about IFSC ecosystem. So gift basically is a gateway to connect our country with the global opportunities, number one. Number two, it will allow companies to do global businesses, global financial transactions without having to go to the foreign jurisdiction. So that is again a very important aspect, that I am in my country, in my home, but the none of the I don't have to actually shift out of my location. That is an important aspect. As we have in India, we have SEBI for Indian ecosystem. We have SEBI for gift. There is gift IFSCA. IFSC authority has been formulated, wherein regulations are being formulated on a daily basis. Daily, they are formulating some processes, some innovations are being done. So as a result of which the amendments which are proposed in the bill have come out. One of the important changes which is proposed is the Indian companies can maintain, which are registered over there, they can maintain their share capital and prepare the books of accounts in the permitted foreign currency. So abhi tak there is still a confusion. The companies were getting registered over there, but they were all in Indian currency, Indian rupee. But now it has been clarified that you can even maintain your books in say dollars or any of the other currencies. It should be permitted by IFSCA. However, any of the penalties or fines which will be levied under the Companies Act would be payable in Indian rupees only. So this is one of the important amendments which is proposed under the Companies Act. Likewise, in the LLP Act, some of the important changes which are proposed are they have introduced a concept of specified IFSC LLP. That means a LLP which is registered in Gift City. So these companies, these LLPs have to use the suffix specified IFSC LLP, number one. Number two, again, they can maintain their books in foreign currency, permitted foreign currency. Uh, any of the companies, rather for the corporates as far as for LLPs, any of the companies which have already been registered over there and they had brought in their share capital or contributions, partners contributions in terms of Indian rupees, they'll have the liberty to convert those rupees into the permitted foreign currency. Likewise, the way we have in Indian domain, any of the changes have to be brought to the notice of the regulator. Likewise, if there would be any changes in the LLP structure or the partners or the relationship between the partners, that would be required to be disclosed to the IFSCA. Next. Now, this again is a very, very important amendment wherein AIF, setting up of AIFs in the LLP form. So under the Indian domain, only a trust can be registered as a AIF. But when we talk about gift, what they have done, what they have allowed, they are proposing to allow is that a trust which is registered with SEBI or IFSCA, that can be converted into a LLP entity which can do the AIF business, which is permitted to do the AIF transactions. So this would enable the legal conversion of and registration of these trusts into LLPs and add to the existing firms and private companies and unlisted companies to operate there. So these two are the broad basic amendments which are proposed in the Gift City regime, and would definitely help the Indian corporates, Indian units, Indian businesses which are wanting to get themselves set up their offices in the gift to raise better capital. These were the amendments which pertained to the Gift City. Yeah.
Okay. Ankit, Narayan, and Amit, the conversion of this LLP structure, do you think, Manoj, any impact on this?
Sir, in India, the AIF structure, which is now evolving very fast in last couple of years, has mostly made in the form of trust. The fund is pooled in the form of trust, and then it is deployed in various companies. The major objective of this is to have a pass-through system. Trust at the trust level, there is generally no taxation. It is taxed according to in the hands of the individual investors or individual or body corporate investors who have pooled their money in the AIF. So that similar structure is also prevalent in the Gift City, the AIF entities created in the Gift Cities. But I don't think there was any legal hurdle to incorporate an LLP earlier. This is the new facility which allows conversion of existing trust into LLP. This is a new thing. Maybe government is trying to promote LLP structure, and then the taxation would be in the hands of LLP, and then tax-free distribution in the hands of individual investors would be possible. So that totally depends on the tax planning of the AIF structure being proposed, not relating to any way. It is just a facility or additional facility available, as per my view.
Okay. So now next, these are the changes, and it will in the next program when we'll discuss with Pradeep and of the Gift City, we will talk about this. Anybody wants to say anything, Nara and GP, relating to the Gift City?
Nothing from my side.
Okay. So now let's move to M&A. Now this particular thing which is there, and Manoj will tell the IBC single window streamline approval, which was a demand of under Section 233 of the M&A, and the demerger issue. That now I was asking why the official liquidator was required when the demerger was taking place, but it was there. Cross-holding cleanup. So Manoj, over to you.
Yeah.
What is the change? And then you tell us the impact. And then Madan and Amit, you please add your point. In your practice area, you are finding these things every day.
Yeah, so with respect to mergers and amalgamation and demergers under Companies Act, the proposed amendment in the corporate law bill is mostly to simplify and create the faster process rather than structural change. There is no major structural change proposed in this amendment. However, the impact is very high. And basically, the impact is because of the changes made with respect to the fast track merger route, which is provided under Section 233. So first I should let's clean up the amendments made with respect to the NCLT mergers. So with respect to NCLT mergers, they have made one smaller change, that where a company is under liquidation under IBC law, it should not be eligible for compromise and arrangement under the Companies Act. That is just a clarificatory kind of amendment proposed. Another one, which is more important, is that they have made it simplified, that in case the companies which are part of the scheme of a merger or amalgamation or demerger are falling under two different NCLT jurisdictions, the application shall be filed only with one NCLT, that is the NCLT where the transferring company or the resulting company is registered. So it will obviously reduce the duplicity of the work. There will be no double filing, and also it will reduce the burden of NCLT benches. Because of this, the dual application, dual jurisdictions, two applications were being filed for one single scheme. So that would get eliminated. So it will simplify and reduce the burden of NCLT. But the changes made under the fast track route under 233 is quite wide. Now, there was a major amendment with respect to the fast track merger on 4th of September last year, and that was made effective from 8th of September last year, where the jurisdiction or the threshold was drastically changed. All the small companies were already covered under the fast track route, but they have said there were also the law that all holding company and wholly owned subsidiaries were covered under the fast track route. But through the amendment of September, they have brought all holding company and subsidiaries company within the jurisdiction of fast track route. Again, they have said or unlisted company where the total liability is 200 crore or less could have been covered under the fast track route. They have also allowed merger of holding and subsidiary companies of where the one of the company, that is the transferee company, is a listed company. They can also come under the fast track route for the merger and amalgamation. However, there was practical difficulties. The thresholds for the approval from the shareholders and creditors were quite high. So now they have rationalized the same. Now the threshold has been reduced for creditors from 90% to 75%. And that too, similarly, for the purpose of shareholders approval, they have said in the meeting, whoever is present and voting should be considered, and based on the same, 75% or 3/4 majority approval would be required. So that makes life quite simpler, quite easier for most of the companies. And hence, most very wide spectrum of company would be able to go through the fast track route. Even the listed companies, where the listed companies holding company is the holding company, can go for merger through fast track route without going to the NCLT route. So that makes a big change. The process timeline would drastically get reduced. The process would also get changed, because there will be no NCLT appointed chairpersons and then meeting under their supervision. It will be controlled system, like any other resolution being passed. It will be passed, and then approval would happen within 60 days as per the mandate given to the regional director MCA. So that is a big change. Similarly, there was a lacuna, or that in fast track merger, every draft scheme need to be filed with ROC and the official liquidator for pre-clearance for 30 days. But that was not logical in case of demergers, because demerger, the role of official liquidator comes only when there is a dissolution of a company. Here in this case, because of demerger, there is no dissolution. Both the company survives, both or all the company gets survives in the post the scheme. Hence, there was no purpose of involving the official liquidator, and hence the requirement of filing application to official liquidator in case of demergers have been dispensed with. So these are the major changes. Besides this, I think there is a proposal to amend the definition of a small company threshold under the company law. Earlier, right now, it is 10 crore rupees paid up capital and 100 crore rupees turnover, which is now being proposed to increase from 10 to 20 and 100 to 500, which is a drastic change, and it will also cover a huge number of companies. So right now with the amendment, there will be very few companies which will go to NCLT, like big companies where there is a huge debt, and they are not a small company, debt of 200 crore or more, or the companies which where in the scheme the listed company is not connected with the company which is getting merged into the listed company, or where listed company is the transferee company and getting dissolved under the scheme. So in such cases, it is not allowed. Besides that, obviously, those companies which are having negative net worth or not solvent cannot use the window of fast track merger under 233. So these are the cases only where NCLT route would be applicable. In all other cases, it will be simplified and fast track route would be available.
Okay.
Similarly, they have proposing to insert a new section 233A, which is just to clean up old cases. Now, in case of any merger, if there is a cross holding, we cannot keep the cross holding shares in a separate trust, which was prevalent under the 1956 Act. So that amendment was already there. But because of that, because there were various companies where this kind of trust share, cross-holding shares were continuing in the books. So to clean up that, they have given a window of 3 years. And if they are not able to dispose of those shares to the market, or otherwise reduce the number, then they will get automatically cancelled, and it will be considered to be a reduction of capital. So these are the major changes which are being proposed. I think if approved, all the amendment, it will help to fast track the process, simplify the time, reduce the timeline drastically.
Okay.
As sir was discussing, there were quite a few things which could have been brought under this amendment and should have been considered. Because it is a corporate law amendment bill, they could have touched upon the stamp duty issue, which is very critical for any scheme of amalgamation. At least single jurisdiction for the stamp duty could have been enforced through central law, by amending the Stamp Act relating to this part only. That could have been a very good thing, but that is not there. So
Okay.
let's see.
Okay.
Yeah.
So now first, Madan, this IBC changes that Manoj has started. What you feel the duplicacy and what will be the impact?
Thank you, Pawanji. First of all, my compliments to you for holding this event within 3 days of tabling the bill before Lok Sabha and sending the bill to JPC. And you are again, as usual, the front runner in this. Now, you have very beautifully explained the rationale of this corporate laws amendment bill in the beginning and summarized that. And then, as far as this merger amalgamation or scheme of compromise arrangement is concerned, Manoj has given all the statutory proposed provisions. With respect to this change under IBC, with respect to section 230, companies that came in 2013 and when IBC came in 2016, section 230 of Companies Act 2013 was amended. And it provided that in case a company goes into liquidation, in that scenario, there may be a scheme for compromise or arrangement. But I tell you, though this provision was introduced, but no clarity has been provided during last 10 years. I still remember in the year 2017 itself, I spoke to the Joint Secretary of Ministry of Corporate Affairs, please provide some clarity so that this particular provision can be complied with in letter and spirit and can be used in the case of a liquidation of a corporate debtor. Under section 230, a scheme of compromise may be given either by members or the creditors. But what is happening ultimately in the market, that whenever a company goes into liquidation, the liquidator comes out with a public announcement, a public advertisement that I'm in the process of complying with section 330, or anybody on this earth can come out with a scheme and give a scheme of compromise or arrangement. So the person giving this proposal may or may not be a creditor, may or may not be a member, and this section 230 scheme was open to everybody. And that was to me, that was a gross misuse of this provision in case of liquidation of a corporate debtor under IBC. And further, though the IBC provides for 3 months, the company goes into liquidation, within 3 months, section 230 scheme should come. But what is happening, I have seen even after 3 years of the company going into liquidation, the scheme under 230 is coming forward. And the NCLT benches are entertaining those schemes and they're sending the company for settlement. It means because at that point of time, the people are raising an issue of they are actually discussing about the preamble of the code, that a preamble of the code talks about a restructuring rehabilitation. So therefore, this compromise scheme or arrangement scheme is also a rehabilitation. Let the company not go into liquidation. Let another attempt be made with respect to rehabilitation of the company. And I'm telling you, similar provision is there in companies IBC amendment bill also. But I'm really surprised when IBC amendment bill is pending. Now such a proposal is coming through this company, the corporate laws amendment bill. I think something has to be deleted from IBC, proposed IBC amendment bill, which has already been revised bill, has already been tabled before Lok Sabha. And it was debated also day before yesterday. And Pawanji, you talked about that with respect to NCLT benches and all that. You must have heard that one of the member of parliament, Mr. Chandan Chauhan from Rashtriya Lok Dal, he spoke in favor of the bill day before yesterday, and he said categorically that if you want to bring any change in the insolvency and bankruptcy code, first of all, have more number of NCLT benches, have more number of members, and have entire infrastructure of NCLT in place. Otherwise, there is no point of bringing these changes. And I have no hesitation in admitting that when Mr. Chandan Chauhan came to one of our events last year at PSG Chamber of Commerce and Industry, we gave all these points to him, and we are really fortunate enough that he has carried those points with him and really discussed those points in the Lok Sabha. So this, no doubt, this is a now, but what the proposed change is now that the 230 scheme will not be applicable in case of liquidation under IBC. So blanket ban is going to be there, and I'm happy. At least some clarity is there. At least that clarity was needed, whether it's applicable or not, time limit should be there or not. At least I'm very happy that at least now they are providing a clarity. Good or bad is a separate issue. The feedback will come from the stakeholder, but at least some clarity is there. Now, coming to the next change, which Manoj also discussed with respect to the jurisdiction of NCLT. What was happening earlier? It was happening both the company transfer company, transferee company, they were going to both two different high courts. Now they were going to be for two different NCLT benches. But now they have said only the jurisdiction of that NCLT bench shall have jurisdiction where the registered office of the transferee company is situated. So it is a very, very welcome provision. I support this proposed amendment. And they have also said in case of existing M&A activities which are pending before NCLT benches, they will be governed by the existing provision. It means if there are two different benches, the two different benches will be handling this case. So this is as far as 230 is concerned. Coming to I'm not touching upon all the provisions. I'm again happy that they are bringing this change that in case there is a demerger or transfer of the undertaking of the company, this scheme will not go to official liquidator. पवन जी, I tell you in NCLT we are seeing, जैसे वो एक मूवी थी ना अरशद वारसी वाली, तो वहाँ पे जज साहब कहते थे कि सबूत है कि हम वेट करते रहते हो, सबूत है कि आता ही नहीं है। यहाँ पे M&A में वेट करते रहते हैं कि आरओसी की रिपोर्ट आ रही है नहीं आ रही, आरडी की रिपोर्ट आ रही है नहीं आ रही, ओएल की रिपोर्ट आ रही है नहीं आ रही, हम इंतजार करते हैं अभी आ रही है अभी आ रही है अभी आ रही है। एवरी टाइम द लॉयर इज सीकिंग adjournment is being granted. So at least now one of the council or one of the authority will not seek any adjournment, and that is official liquidator. In case of demerger or in case of undertaking is being hived off to a different entity.
Okay.
Third, Manoj has discussed with respect to earlier the compromise arrangement has happened, and there have been certain shares which are in the name of the trust now, that within a period of 3 years from the date of notification of this amendment act, proposed amendment act, all those shares have to be disposed of. And if those shares are not disposed of, all those shares shall be treated as distinguished, what is it called? Extinguished. And it will amount to reduction of share capital. But I'm surprised to see, I think this is in itself is a punishment, extinguishment of shares. But it says if you do not comply with the share, there will be further penal provisions also. There's a double penalty according to extinguishment of shares if you do not dispose of within 3 years, and further penalty also. Here, as far as the penalty is concerned, I'm not in this favor that this penalty should also be imposed. I think this is with respect to merger and amalgamation. Pawanji.
Okay. So thank you very much, Madan. Amit, Narayan, you want to add in this? Otherwise, you will get lots of chance away. Anything? Yeah.
If Amit wants to go ahead, otherwise I had one small point on the
Yeah, you tell.
Okay, I think it is there in the screen also about Pawan on section 233A, correct? It's because currently, as both Manoj had also pointed out, 230, 232 has an explicit prohibition that treasury shares arising on account of this compromise will have to be cancelled and extinguished. So this is more in terms of treasury shares which were held prior to the commencement of Companies Act 2013. That is under 1956 where these schemes were there, correct? The key point, one point which is probably missing, just wanted to highlight that while it talks of a 3-year period, correct? That within 3 years, the only one point which is missing both in the slide and generally in the discussion, correct, is the word dealt with. Okay, because today treasury stocks under the company amendment, they have said that within a period of 3 years it has to be dealt with or disposed of in a manner as may be prescribed. So one is disposed of, I can clearly understand the meaning. We have to dwell probably and take what do you mean by dealt with, because both while dealt with will include disposal, but it is not limited to disposal, correct?
Okay.
So I was just thinking dealt with would probably cover is it while disposal, transfer, sale would be cover, cancellation or extinguishment could be there under that. Uh, and a lot of key companies trailing merely making such treasury stock not carrying voting rights will be enough. Probably questionable, but we have yet to discuss and deliberate on that. Uh, is it that if you're telling dealt with? Is it holding through a permissible structure allowed, rectification of register, or again would you find court tribunal approved arrangements coming out from companies uh, coming under the garb of dealt with? Because if you see what are the prohibitions in this regard, one is 67, company can't acquire its own shares, correct, not allowed. Second is buyback of shares. There also it is clearly stated that immediately upon buyback you will have to extinguish those shares, correct. 66 again you will have a capital restructuring, correct. And 233 a which route requires a cleanup in view, clean up in terms of dealt with, or you can say disposal of, correct. uh, so is there an interpretation to say that shares are regularized, need not be sold? Since the term as may be prescribed is added, probably the rules may clarify, or when we are making presentation, this could also be covered, correct? Of course, we all understand the requirement is stemming from what? They don't want shell companies to be there, and there are issues both under SEBI, PMLA, and others. So the intention is well understood. The only limited point I wanted to tell is it is not merely disposed of. The language is dealt with, or so I just read that language in 2233A. Such shares shall, within a period not exceeding 3 years from the date of commencement of the Corporate Law Amendment Act 26, be dealt with or disposed of. And subsection 2, 3, everywhere there is a question. So while I've given you my initial views, would love to hear from the other panelists and Manoj and others
I
what they
think
could probably be thinking of dealt with.
I think only other option seems to be distribution in the form of bonus shares to all the existing shareholder proportionately. That would not change the paid up capital, and percentage holding of the public share, all shareholder would remain in the same ratio. So that can only be other solution. Other than that, I don't think any other option is available to us.
Okay. Amit, you have any view other than what Narayan has mentioned in
Yeah, one
something?
very small point on the point what Shankar sir has just now mentioned. I think government has created a power, right, as may be prescribed. So dealt with will also be prescribed by the regulations, by the rules of the government. And what Manoj is saying, I also concur with that. Perhaps that could be one solution which comes to my mind. Perhaps government may also be thinking on that line. I have one point what Manoj has mentioned, then Madan sir has elaborated on the insolvency. My take is little different on the deletion of the word insolvency and bankruptcy code. What I understand, the schemes which were being done under insolvency and bankruptcy code, they were under insolvency and bankruptcy code without any reference from the section 230 of the Companies Act 2013. And that is the reason why they have so far not came out with the any similar amendment in the insolvency and bankruptcy code. So I'll give you the example. One of the very few first cases which were resolved through restructuring in the insolvency. I happen to be part of that. And that time also we were discussing and debating how restructuring can be done. And that is a very unique proposition where you are not required to follow the provision of the Companies Act. Simpliciter NCLT approves the resolution plan, and by virtue of that resolution plan approval, your merger application is getting approved. Neither transfer company nor transferee company is required to follow any of the process. So I understand the way NCLTs have perceived, it is altogether a different power under the IB code, which they are using for the purpose of approval of a resolution plan for M&A. Number two, the point what Madan sir was trying to indicate with regard to the compromise or arrangement in respect of companies which have been put to liquidation, At that stage also, whatever comes that comes under the power given to the NCLT under the IB code, and the scheme is also filed like that only because there is a specific provision in the insolvency law which enables, perhaps, that is again because no black and white rules are there, but NCLTs have been doing, we all are aware. So that's my take, that perhaps what is the reason why they are deleting, I am yet to discover that. Because language, if you see of 230 where it is coming, it says that where a compromise or arrangement is proposed between company and its creditor or class of them, or between company and so, the tribunal may, on an application of the company or of any creditor or member, or in case of a company which is being wound up, of the liquidator appointed under Act, that is Companies Act, or under Insolvency and Bankruptcy Code 2016. By deleting or under Insolvency and Bankruptcy Code 2016, I think intention is that under 230 compromise or arrangement will be barred by the liquidator. But I am yet to get a clarity. Maybe if Manoj has got deep further research on that, maybe he can elaborate. But my take is that insolvency restructuring will continue even after this deletion. That's the only point that I wanted to make. One more point, what is surprising to me is there is an amendment in section 230, which is 233, sorry, where it says you are not required to take the approval of official liquidator in case of transfer or division of an undertaking. Very fair point. But why similar provision is not there in the case of a NCLT driven merger? Similar provision should there be for the NCLT mergers also, na? Because this is a 233 amendment only, right? When I'm doing a fast track merger, then this exemption is proposed to be given. But what about the cases which are before NCLT? That case also, the same analogy applies, that OL has got no role because the
Yeah. So, Amit, practically in case of NCLT route, there is no reference to OL in case of demergers. We have filed various applications, and a specific prayer is there that this will not be considered to be a regulator for this purpose, and hence no notice to be given
I
to the
agree.
regulator, and they allow.
Practically, we have been doing because there is no specific exemption. Either you seek a specific exemption at the time of getting the order from the NCLT concerned, then otherwise OLs are holding the report and they are saying that we have to file the report and you file the documents to us, and there are different practices across the country. I'm saying when we are bringing a clarity, I think a line of similar insertion in the 230 also can be a relief, right? That's the only point.
So
I take your point.
230 subsection 5 has list of multiple regulators, but many
Correct.
may not be applicable, like stock exchanges, SEBI, etc., also given, CCI and RBI, everything is given. Now we have to select which all regulator we believe that they should be referred to, and accordingly the order is passed. So I think for NCLT there is a specific order, but in case of fast track merger, it is a pre-clearance kind of thing. You have to file the draft scheme with ROC and official liquidator, where official liquidator is now being deleted. So there was no judicial person to judge here. That's why it was very important.
All right,
Okay.
I think point.
Okay, let's we will do separate session on this. Today's session is index session to do this. Now, second portion is ESOP. Various changes have taken place. Over to you, Mohini. You have done more than 500 companies ESOP policy you have made. Now, please tell us what changes and how it is impacting.
Right. Thank you and good evening to everyone. So with respect to start with that, what the amendment has came now. So I go back to the previous Companies Act when the ESOPs altogether not being a part of in the entire Companies Act. There is one definition they have given, but per se rules, regulations are not there. But in the listed company space, in the ESOP guidelines 99, there was the concept of ESOP, and generally we are considering that particular thing when we are doing that. Now, when the 2013 Companies Act came, they take that 99 guidelines and made that rules and regulations based on that, and made it parallel with what the guidelines of the SEBI says about. But in 2015, because listed company space has considered more, the SEBI is more proactive on this approach, and they have considered global instruments, global behavior, how the employee benefit schemes run. Accordingly, in 2015, when the ESOPs new regulations came, they considered all these instruments like SAR and ESOPs and various other instruments are also there, where the equity shares are allotted for the benefit of the employee. So for that, a complete overall new regulations came, and now the listed company SEBI guidelines covers all these particular instruments. Now it's a welcome step that now the Companies Act also considered these instruments and are recognizing this by including the word that any further equity shares of the company pursuant to the employee benefit schemes linked to the value of the company, then they will be coming, they are trying to recognize the instruments like RSUs, this is the restricted stock unit, and the stock appreciation right. If I talk about the present scenario before, if that, this amendment will not become, so then presently we are, for the unlisted companies, we are following up this in the ESOPs present section. And because generally, globally, the rule for issuing the ESOP or any equity linked benefit are same. It goes through the same process like ESOP, grant, vesting, exercise. So in the similar manner, we will be issuing presently RSUs and SARs in the same manner. But yes, through this particular share linked value, share based value benefit, then it will, and the rules when it comes to it, we will be able to get the clarity on that how the RSUs are being treated now, whether it will be same as like the ESOPs rules are. And the important thing is when it comes to the SAR, it helps us to understand the appreciation calculation. And I hope that these instruments, to make it parallel with in the entire corporate laws, like either it be a SEBI or the this Companies Act, they will follow the same rules and rules which generally in the listed company space we are following now. But to my these two RSUs and SARs are being treated as now they can become a part of it. But my another one point which I still feel that it's missed out or might be get covered is the instrument in the other instrument is the ESPS, that is the Employee Stock Purchase Scheme, which is again a further issue of capital is there, and that is for the employee benefit. But because ESPS is very different from how the ESOP work, so presently in as per our understanding, we can't cover the ESPS under 621B, and we don't find any guidelines which are in the Companies Act presently, as well as now. I don't know whether this new when the rules come, they will incorporate this ESPS to make it more wider and to include all kinds of benefit in this. Also, the two things which the other schemes which are there, like the retirement benefit scheme or journal employee welfare schemes are there, which are being recognized in the SEBI when it comes to the employee welfare. And these two trusts or these two benefit schemes, when it owns the shares of the company for providing the benefit to the employee, whether they will be covered or not. But it's again be dependent upon that further issuance of capital or not there. But that's my point. But the last, I say ki, if possible, because employee benefit schemes are now a very important, employees, this be recognized as a very important asset in the company. Now, if employee welfare section, like a separate rules and separate regulations as the SEBI has carved out for this particular thing. So instead of merging everything under section 621B, if it can be made as a like any director's remuneration or something, like separate sections are there. If it can be an employee welfare schemes, including equity capital of the company, if a separate section comprising of different, recognizing different types of instruments, different flexibilities which it requires to, if that can be incorporated, then that will be very good step the committee can make. But presently, yes, through this RSU and SARS recognition, it will help us to give it more structured manner and recognized instrument as per in the unlisted space. So that's from my side and my some points in this particular amendment.
Okay, Mohini. Narayan,
Yeah,
you have done a lot of work in this, and you are one of the seasoned professional in ESOP, and I have seen the SEBI committee the way you have contributed. Now, what is your view on these changes, and what is missing? It's confined to this particular thing. Then we'll go to the other topic where
sure.
involvement
Thank
and
you.
yeah.
Thank you, Pawan. First, thank you, Mohini, and very nice to know that you have cleared almost 500 ESOP schemes. Amazing, really. And lot
Yes,
of
sir.
learning from you.
Yeah.
And you very nicely covered, Mohini, about 42, 62, and 68. And it's a welcome move that other schemes linked to value of share capital, effectively providing statutory recognitions to RSU and SRs, correct? And of course, global executive compensation can be issued with shareholder approval. I'll just try to give a nutshell of the impact of these provisions on the industry. One, the very fact that the language uses such other scheme linked to the value of shares capital means cash settled SARS, of course, is not contemplated over here, correct? It's a separate topic not to be mentioned over here. Second point, a company can do an issue of shares to employee under 62 on preferential basis without any hit to the P&L, correct? So the main thing is in ESOP today, because ESOP was the only second other vertical in 1A, B, and C. If you didn't have a ESOP scheme, and if you had an ESOP scheme, difference between exercise price and market price was a hit to the P&L, correct? This is today a welcome change. Second, this can be done under such other scheme beyond ESOP scheme. And since preferential, as I mentioned, would be at fair value, no need of taking a hit in the accounts. Most important, if you do a pref to employee, because there is a separate vertical or under 62 1B, 62, employees will not, sorry, under 42, employees will today not be counted in the threshold number of 200, provided there is some scheme linked to the value of the capital. So today, companies where they want to do a pref to employees can need not come under the 200 limit. And if you got a big company with thousands of employees, correct, could be unlisted also. I thought it's a very welcome move, correct? Most important other point also, in an unlisted, the ESOPs are today some many a time seen as illiquid, because unless and until you get an exit opportunity, correct, there's no point. And the exit opportunity, Mohini and others, will only be probably in an IPO or some other case, correct? Today, probably employees will get an additional comfort as exit offer for employees beyond ESOPs and sweat equity is a separate vertical or a class from which buyback can be made. So probably the employee letter, I don't know, Mohini, I'd like to hear from you also. The employee letter exit, the scheme can have a separate clause on this. Of course, the letter can say it is subject to compliance of section 88, 68, free reserves, security premium, and proceeds, if they have. Listed entity, of course, if there are RSUs, which is basically deep discount, correct? Even if your share price is 1,000, if you're giving it at face value of 10, then such vesting will have to be conditional as per proxy advisory. So that will have to be taken care and not merely by flex of time. Just like Mohini, you had given some suggestions as to a separate provision, etc. We also need to align the class of employees under the Companies Act. And when through Pawan, we are going to make representations to MCA on what are the changes. they can also probably align class of employee under the act with SBB regulations, correct? And one of the key changes is employees of Holdco, Subco are covered under the Companies Act, but associate is not covered, which is covered under the SBB Act. So I thought these two, three changes, if it can be done, it will be great. While on 62, 68 and 42, Pawan, I just had one extra point on 4210, but it will not be pertaining to, but it is pertaining to pref issue, which is important. If you permit, I can make it right now.
Yeah.
Okay. So Pawan, this is regarding 4210, where the penalty which has been changed from which may extend to 2 crores to a plain equivalent of 2 crores, correct? So companies will have to be extremely careful because we have seen many ROC orders, correct? Where even sometimes they have gone up to 2 crores, whether it is separate bank account to be opened for a receipt or share application, keeping a record of persons to whom private placement is made, filing of MGT 14, PAS 4, PAS 3 sometimes is filed before utilizing application money, contents of explanatory statements, and there are multiple orders which for company not opening bank account. MGT 14 after sending the offer letter. No mention of section 42 in the resolution. Separate account is opened, but it is not transferred. Delayed filing. All these were ROC orders, but an important thing for all company secretaries is the end use of proceeds of preferential issue. And there was a landmark judgment just last week which came from Supreme Court, correct? Which clearly brought out an important point. Post facto shareholder resolution in terms of preferential shares, correct, is not allowed. That means you cannot have objects of the issue change by way of a ratification. So that it is the hue, and in this case, SEBI has also invoked FUTP, that is unfair trade practice, if the objects are different. So in this particular case, while the company had given 4 or 5 use, correct, like capex, acquisition, working capital, etc. Soon after receipt of fund, these were entirely used for share investment, loans and advances, correct? And one of the things where you are aware, if you have done that and you have to ratify, the only ratification under the Companies Act allowed is section 27. And since you have done a pref, 27 has no application. However, the company still went ahead and ratified under 27, correct? And they tried their best to get into a position of analogy by saying 62(1)(c) is subject to compliance of chapter 3 and 27 is in chapter 3, and hence I will use the principle of analogy, that is companies seeking to apply underlying rationale of 27 to 62(1)(c), even though the provision itself does not directly apply. More importantly, SAT had given a judgment to say that once the utilization of proceeds have been ratified by shareholders, acts and deeds done by the company become valid and authorized. There was no variation of the utilization of the proceed. And since utilization has been ratified, there was no variance in the utilization of, and consequently no violation. Supreme Court has set aside this order, and I thought it's a very nice order for all company secretaries because they clearly made a mention 62(1)(c) deals with allotment of pref, correct? 62(1)(c), while it deals with chapter 3, even if analogous principles are applied, it would mean situ conditions stipulated in 42, which is part 2 of chapter 3, and not section 27, which is part 1 of chapter 3. So it doesn't revert back to section 25. So they have very nicely said that there is no provision in the Companies Act to ratify or change the objects of preferential issue, correct? And one more point which is coming out very clearly is what is general corporate purpose, correct? Because generally you will have 3, 4 purpose and you will say the net balance will be used for general corporate purpose. They very nicely even analyze what is this general corporate purpose. And if the company didn't have any operations at all, the question of any general operation doesn't arise. So CS need to be extremely diligent As you're aware, if it is a listed entity, pref allotment, ICDR, Chapter 5, Companies Act, 42 read with Rule 14, 62 1C read with Rule 13. I thought 40 to 10, making it very, very vulnerable for all compliance profession, because today it is not even up to of, it is equivalent to the proceeds of the issue or 2 crores, which is the fine. Thank you. Thank you, Paul.
Okay. So now, Anjali, unmute.
Talking about the Supreme Court judgment which Narayan sir was talking about, but this is so rampant, sir, that
Anjali. We will cover later on, because I'll tell you.
चलिए, fine.
का चैप्टर बहुत बड़ा है और उसमें बहुत important चीज है. This is थोड़ा out of syllabus जा रहा है. Ankit, over to you, because you have so many suggestions. So Ankit, what you finish it, and then I will ask questions from Amit, Narayan, and Manoj or Madan.
Okay. So good evening, everybody. At the tail end of the webinar, I am now beginning with discussing other substantive provisions where the change is proposed under the bill. So I think we are all aware the government has been on the spree of converting a lot of punishments which are punishable with fine to the penalty regime under from compounding to adjudication. So similarly, there are further decriminalization where provisions of buyback, AGM, books of accounts, vacation of office. Now all these are proposed to be shifted to the penalty regime where it will go for adjudication. And then in some cases, the amount of penalty has also been increased. Strike of valuations, producer company, foreign company. So there are a lot of defaults which were earlier subject to fine, now have been proposed to be shifted to the penalty regime and will be subject to adjudication. And as I mentioned, in many cases, the fine penalty has been also increased. Next, Shivam. Then in some cases, like section 4, subsection 5 or 159 or 249, in there the penal amount was subject to certain limits, like up to 1 lakh, up to 5 lakhs. Now they have been reduced to a standalone amount of a single amount instead of from start to beginning. Then certain amount offenses like which are related to non-following the orders of the tribunal, they have been shifted to the contempt regime instead of subject to any kind of a penal regime under the Companies Act. So for example, if you don't comply with AGM instructions or 222 instructions relating to transfer or 242. So these are all where some penal provisions were earlier provided. Now they have been shifted. If you don't comply with the order of the tribunal, it will be treated as a contempt. Then new penal provisions have been included for section 40, 147, 166, 188, 189, where certain new penal provisions have been added. Like for example, in case of 186, which was subject to imprisonment, now provisions with respect to maintenance of register or inspection of register have been shifted to a penal regime instead of a regime where imprisonment was there. So similarly, there were other sections like 147, which was dealing with the fine related to audit statutory auditors, 148, which was related to cost auditors. So a lot of these provisions where there was fine for certain class of offenses under these provisions has now been shifted to the penalty regime instead of the fine regime. Similarly, in case of 166, duties of directors regime has been changed to penalty regime, and different fees have been provided for directors of listed and unlisted companies. Then, with respect to the setting up regulating declarations, so like for example, some declarations which are required for CACS are not required only when they were engaged in the incorporation process. So if they are helping in you in the process of the incorporation. Then under, I think others are not so important. Yes, a new mechanism, and aggrieved parties can now appeal to registrar against the decision of the registrar with respect to incorporation or name. If there are rejections, the government will set up a appellate authority in form of joint director, where you can file appeals against the decisions with respect to section 4 or 7, section 4 with respect to memorandum. So more space, I think importantly, we should be dealing with the change of name or change of objects where the approval is required, and with respect to section 7 where it talks about incorporation. Next. Now again some new requirements are being prescribed. So now the prescribed class of companies which the central government will outline after the the bill is enacted, which needs to have a website, an email, and a digital communication mode. They need to mandatorily have a website, and any changes in such will require to be submitted to the registrar of the companies. Similarly, under section 20, service of documents, electronic delivery has been included specifically. And then under section 139, which is the significant, certain prescribed of companies can now be exempted from the requirement of appointing statutory auditor. So government may outline prescribed class of companies, most probably certain class of companies falling under the category of small companies, which would not be required to appoint a statutory auditor. So audit would not be a mandatory feature every year. Then in respect of closure, certain new grounds have been added as a closure where ROC can close, where there are no significant accounting transactions or companies have failed to file annual return or financial statements for 2 years. In addition, the most important change is with respect to now individual company can also apply for strike off on independent grounds. For example, where company is not carrying on business or for any other reason, they can now apply independently in spite of in addition to the grounds which are mentioned under section 248. So now we need not to wait for for example, current requirement is you have to wait for a 2-year period to show that you are not carrying on any business and then go for the striking off. This was something which was also discussed in the Niti Aayog, and I believe it is also a result of deliberation that took place there, that there is this proposal that you can also apply independently, and if a company believes that it can apply for the strike off and meet the conditions of nil assets, nil liabilities, they can apply for the striking of application. Other important thing is companies generally tend to find it difficult to extinguish all the liabilities, which is the key condition. Now, government will also prescribe certain manner in which these liabilities can be prescribed, so which can further add on to ease the process of striking off. Another is that in case your company remains active, which means you have not filed annual returns or for a period of 2 years of financial statement, then you have to mandatorily apply for a dormant company status. This is a bit of a conflict with 248, where the registrar is being empowered to strike off these companies. So I believe in case these companies don't go for obtaining the dormant status, which is a mandatory requirement, then the registrar can straightforward go and strike off these companies. So this is also significant. Then in case of significant accounting transactions, new class of clause has been added, which allows that if you are receiving any payments or you are making any payments which are not related to business operations, they can be classified as not forming part of the significant accounting transaction. So this will also help you in continuity of the dormant status, because earlier companies were finding it difficult. Sometime a big payment was received for reasons which was not supposed to related to business. For example, some investment was sold off, some other thing was done. There was no clarity whether this will be treated as a significant accounting transaction or not. So this will further help in these companies in continuing with their dormant status. Next. Now timelines, charges for certain class of companies, they will prescribe the window to be increased to 120 days. I think what is missing still is that for companies who are not able to meet the prescribed timelines, there is still no provision for condonation of the delay. I think that is something which is a must requirement for registration of charges. Then under the new act, because of I think some last amendments, there was no specific provision which deals with no notice of trust, which was there under the Companies Act 1956 too. I think that is supposed to be brought back under Section 88, that only trustees will deem to be the members. Then under 403, in terms of the current fees of 100 rupees per day, there is a provision to give powers to central government to prescribe a lower rate which can be lesser than 100. Then on board and shareholders meeting, there is a provision for shareholders meeting for doing them on an hybrid or OEVM. In case the members, prescribed class of members request, then they need to be held in an hybrid form. Mandatory one AGM to be done in physical form every 3 years. I think it's, I don't think people will like this, but I think it's an important move. There has to be some physical interaction. And another important, very significant move is to reduce the time period of notice in case of an EGM. So while a lot of companies have to go for postal ballot for getting resolutions passed apart from AGM, and where they don't want to do it EGM, in case of EGM now, you can reduce it to 7 days, which is a very, very significant amendment if it goes through. And companies will find it much easier to get this passed through EGMs instead of going through a postal ballot, which is still exercise of around 30, in total 35 days. So EGM notice bringing to 7 would definitely bring a lot of ease. Then for small companies and OPC which are required to conduct 2 meetings, proposal is to further reduce it to 1 meeting. And for interested director, there was this requirement of submitting MBP1 every year. I think this is also a very welcome move, that if you are not required, if there is no change from the MBP1 that you have submitted in last financial year or for the first time, you're not required to give that MBP1. And I think this is a very significant change in terms of administrative maintenance of these forms and the obligation on directors to give such disclosures. So this will definitely add a lot of value. In CSR, there are significant proposals, increasing the net profit requirement to 10 crores instead of 5 crore. Will take away a lot of companies from the ambit. Exemption of CSR committee from 50 lakhs to 1 crore. And then also the timeline to spend the unspent, transfer the unspent account in the account from 30 days to 90 days. So again, significant amendments in all these 3 topics of filing, board shareholders meeting, CSR thresholds. Then some producer company related amendments, like first AGM, which was required to be other than 60 days, I think now it's extended to 6 months. 90-day director election limit has been omitted. It can be appointed at any general meeting. Then there are provisions for internal audit, lowering of quorum, loan default allowance now has been proposed to be doubled to 180 days. So a lot of changes on the producer companies, which very rarely see any amendment, and in terms of the scheme of things that is provided under for producer companies. Then buyback, I think expanding, I think modernizing capital, Moini has already entered certain prescribed class of companies to buy back at a newly prescribed percentage. So that will give companies either a more expanded amount to buy back their shares. Then 2 buybacks can be done within a period of 1 year, minimum gap of 6 months, which is currently you have to do wait for a year to do the other buyback. That is also very important. And affidavits have been now eliminated. Declaration of insolvency is removed. Need not to give any further declaration of affidavit of insolvency, and then fine has also been converted to penalty. So welcome amendments under the requirements of section related to buyback. Next, I think on the buyback, on the 25% limit amount, if there can also be some clarity, different people consider that as differently. Some consider that as an amount, some consider as number on limit of shares. If that clarity can also be there, we have very clear view that it is on the amount, not the number of shares, but still there is a lot of views on the number of shares also. So if that can also be clarified, that will also help in making it more smooth. NFRA, yes, there are a lot of provisions in strengthening NFRA. A lot of powers have now been given to NFRA in terms of debarment of audit firms, levying penalty on audit firms, investigation. So a lot of new powers have been given to NFRA, and it seems that government intent is to make NFRA a very effective institution and a very an institution which will have a very deep oversight on the functioning of uh, the auditors in the country, and therefore a lot of provisions have been proposed in order to strengthen their position, um, about chairman, about their powers, about non-compliance of their powers. So a lot of things have been outlined in terms of the NFRA provisions. Constitution of dedicated fund, or registration of auditors, authority to impose penalties, uh, regulating the activities of auditors, charge fees. Lot of things have been prescribed to be included for NFRA. Penalty right is something which would be very significant. Board, in case of a board report for certain matters, like under the current board report, board is required to give comments on the observations, adverse remark, qualifications of auditor. Certain key important aspects with respect to having significant impact on the functionality of a company, or which are with respect to maintenance of accounts and certain other matters. In case there is any qualification, adverse remark, then this has to be given in a manner which will be prescribed by the central government. So they might prescribe a separate form, separate window in the form AOC4 to capture these specific kind of comments of the auditor. Then audit committee composition is required to be mentioned in the board report. If board has not accepted any recommendations of audit committee, then they also need to mention. Independent directors, with respect to, there is a requirement that if you are a relative or you are yourself a KMP or employee of a company in the last preceding 3 years, you cannot be an independent director. Now this has also been extended to include the current financial year. So even in the current financial year, if you are a relative of any person who is employed as a KMP, then you cannot be appointed as an independent director. In case of transactions with consulting firm, the 10% limit as prescribed, or such other lower limit as may be prescribed, this is a condition. And another important is that eligibility criteria, that while this is an accepted fact, but a specific provision has been introduced which provides that the criteria of independence has to be maintained throughout the tenure of the independent directors. Further, in respect of the period of 3 years, certain other restrictions like association with the company, now association with the holding company, subsidiary company, associate company, you cannot also associate with such companies during the period of 3 years if you are enjoyed two continuous turnover and you are looking for that break of 3 years between after the completion of two successive tenures. Then another important is that, which is that you need to continuously now hold an active DIN. It seems that if you are not able to hold an active DIN, your DIN is activated, your position tends to stand vacated and you have to seize the office from the amendments that are proposed under section 152 subsection 3, that there is a need of continuous holding of DIN, which was not the case earlier. It is only required that at the time of appointment you need to have a DIN. Now they have specifically mentioned in order to continue as a director, you need to hold an active DIN. Then for additional directors, I think the objective is to link the or sync the provisions alongside SEBI, which now says that approval needs to be taken within 3 months of appointment of additional directors. The Companies Act is also outlined a similar proposal that instead of the AGM, you now need to get the approval within 3 months. Another thing, a person rejected by directorship as at a general meeting cannot be appointed as an additional and alternate casual director. without prior approval by under the Companies Act. So two important provisions with respect to DIN, tenure of independent additional directors, and rejected director cannot be again appointed in a way which to circumvent the powers of the shareholders by appointing them an additional alternate or casual director. Again, with respect to directorships, now new disqualification has been added with respect to if you are penalized under Section 188, you stand disqualified. There are fit and proper conditions that the government will outline. You need to meet that fit and proper criteria, which is like a fit and proper criteria, which is there for SEBI intermediaries or RBI regulated entities. Another significant important is that non-filing default vacation, which was there earlier for a period of 3 years of non-filing of annual return of financial returns, have been reduced to 2 years. That is very significant. And now a clarification has also been prescribed that the disqualification will trigger on the due date when the default triggers. So if the due date of compliance with the second year, as soon as the due date of compliance of the second year ends, and you have not done the filing for last 2 years, then you are immediately stand disqualified. The only thing is the only new leeway that they have given that in case you're holding directorship in other companies, which was earlier you were supposed to vacate them immediately. Now you can continue them for 6 months or period of your existing tenure, whichever is earlier. So you need not to vacate them immediately. You can continue for a maximum period of 6 months once the disqualification triggers under Section 164. Then for certain specified class of companies, the government prescribed that directors cannot hold beyond specified number of directorships. And then another important thing which a lot of KMPs were finding it difficult, that the companies were harassing them in non-filing their resignations. A specific section is proposed where KMPs which are not directors are allowed to file their resignation on their own with the registrar of companies, similar to a different provision which was there for the directors, that they can also file. Next, Shivam, anything is left? Multidisciplinary firm. I think a lot of amendments have been made under both statutory auditor, cost auditor, and secretarial auditors, where a provision has been created that multidisciplinary firms can now also be appointed as an auditor. It need not that majority of their partners need to be either CA or CS. So that is an important amendment proposed in line with the vision of the government to create large multidisciplinary firms. Then auditors will be barred of certain prescribed of companies to provide any kind of non-audit services. Under Section 144, certain class of services you cannot provide. Beyond that, you can provide with the approval audit committee and board. Government will prescribe that in this class of companies, you cannot provide any kind of non-audit services. And this bar will continue 3 years after you complete your audit term. So that would be a significant restriction that is proposed by way of proposed amendment under Section 144. Next, merger, Manoj has already covered. Anything left for me to cover, Shivam? I think I've covered almost all of the things which were there in my domain to cover. We can discuss on some of the key aspects where we think that there needs to be some deliberation or
Okay. Okay, Ankit, let's start with this. So,
Shivam, you can go one by one back. Let's go to back. Compounding रह गया था क्या? अच्छा, okay.
Finish, Ankit, this also you finish.
So compounding, in case of certain things I can provide. In case of compounding, the limit of RD is proposed to be increased to 1 crore. Then appellate authority is proposed to be against the order, or I believe compounding. Assistant registrars are also authorized to act as an adjudicator. And apart from RD, joint directors will also act as an appellate authority against the orders of the registrar of the companies. on adjudication, which was currently only going to the joint director. Specific provision have been proposed now, which allows companies to suo motu file adjudication application, which was missing, while companies were continue to file that even today. But now specific provision will definitely reduce the requirement of again issuing a show cause and then submitting a reply. So that time can be saved. Currently, there is a provision of reducing the amount of penalties for OPC startup small producer companies. Now government has also taken it to it is reduced to more than half. If they want, they can prescribe the same. Name reservation. Okay, name reservation we have already done. I believe CRC has been covered as part of the registration offices.
Copy corrected.
Nothing important. I think one of the important thing is that in case of strike off of the companies, currently you have to go to the tribunal only. An additional authority in form of a regional director is proposed to be created. So you can now also file an appeal against striking of your company to the regional director for restoration of your striked off company. And NCLT can also take here cases against the valuation authority, which is proposed to be established as it appears from the amendments.
Ankit, now it's okay. So
Yes, now we can hear from Amit and others from
So
or their
Amit,
views on key amendments.
Amit, your views. Madan, you also ready for wherever you want to connect relating to these topics which is there. Okay. So I will start, Madan, with you first. Ankit has talked about multidisciplinary, compounding, decriminalization, and various other things related to this NAFRA. So your view one by one. So 5 minutes we can give to all. Then we will take the question answer. So Narayan, Amit, you ready with your comments? Madan, you start.
I have highlighted certain points. One is with respect to this AGM, that it is written that at least one AGM physically in 3 years. I think this physical should be shifted to hybrid mode. Rest 2 meetings maybe through audio-visual mode only, but at least one meeting should be in hybrid mode. I mean, you just simply can't say only in physical mode. In today's arena, you can't say it has to be in physical mode. Maybe some drafting error, or my understanding may be wrong. Another is section 99. They're changing the title also. No doubt in title section 96 to 98 is written, it has to be 96 only. But in the title, they are saying the word punishment is being replaced by the word penalty. That should not be the case, because according to me, punishment includes penalty as well as fine. Because if you see the other sections also, and particularly the mother section 450, 450 talks about punishment, that does not use the word penalty, while inside 450 there is penalty only, but the title is punishment. So in case of 99, the title punishment should not be replaced with the word penalty.
Okay.
Another is notice of meeting. You are saying in case of EGM, not less than 7 days or such other period and in such manner as may be prescribed. Why not to simply say or such a 21 days or such other lesser period as may be prescribed? You are saying 21 days or 7 days or such other period as may be prescribed. It shouldn't be like this. Okay. Unpaid dividend account. I'm having my own, I think rather my own observation. I have a question here. Is it possible as on date the companies are not transferring the unpaid dividend to the IEPF? The
Yes,
simple thing, huh?
Yes, it is happening.
Okay, but then I'm mistaken.
No, but this is also, sir, my point. I have either not read it properly, because companies now under binding obligation to transfer it after every 7 years.
Yes.
I think there is something that is
It
missed, or I
needs to be revisited. Let's park the issue. Let's park the issue. Needs to be revisited.
Okay. No.
Because today, in couple of hours, we cannot discuss the entire amendment bill. I was thinking about that board structure only we have to dedicate one session minimum. And Pawanji, now it's time for you to take the chair of the SSB again to amend these sectoral standards whenever this amendment bill is passed. Okay, now coming to this NAFRA, I'm really surprised that what is the meaning of the word NAFRA shall be a body corporate. And having perpetual succession. It means once you constitute this, it can't be closed. It will have perpetual succession. It cannot be dissolved. Does it mean that?
No, I think, sir, government can
I think
definitely
this is normal.
resolve it.
The using of the
No,
word
companies,
perpetual
sir, in case
succession,
of companies, sir, there is also perpetual succession. But once the company is wound up, unless or until it is wound up, the perpetual succession, there is perpetual
Ankit, in
succession.
case of an institution which is being established by the government only, we shouldn't say that it's still in perpetual succession. This is my personal view. Okay, then in case of NAFRA only, at one place you are saying if the NAFRA imposes some penalty has to be paid and the penalty is not paid, then there shall be levied, the company or the other individual shall be levied fine or imprisonment or both. In addition to this, section 132I says NAFRA can be empowered to levy fee and other charges as may be specified. I mean, NAFRA may levy penalty, NAFRA may levy charges, NAFRA may levy fee. According to me, a day is going to come when all these provisions with respect to NAFRA, the constitutional validity of this will be challenged by none other than the Institute of Chartered Accountants of India. And it will happen very soon. I think NAFRA provisions are very, very stringent, particularly the section 132A to 132K. Then another my observation is that is with respect to appointment of director, section 164. It says that
Disqualification.
yes, you know, if a person has remained an auditor, secretarial auditor, cost auditor, registered valuer, insolvency professional within a period of preceding 3 financial years, he cannot be appointed as a director. Even if you're talking about cannot be appointed as an independent director is fine. But if they cannot be appointed even a director, suppose I am resolution professional of the company, I have brought the best resolution plan for this company. The successful resolution applicant is so happy with my services. He wants to induct me as a director on the board of the company and to take my assistance in running the company. And the provision says I cannot be appointed as a director. I mean, it's too stringent, it's too strict a provision. You cannot say there is going to be any conflict of interest here. And even though conflict of interest is here, you cannot become ID, it's fine. But you cannot say you cannot become a director per se.
Sir, I think in many cases, sir,
Ankit, these are my observations. Yeah,
I am not. But people find it a way to get them remunerated by taking positions afterwards.
I'm sorry. That's not the case.
That's the only way they were thinking.
If at every place you doubt the professionals, their capabilities, their accountability, I mean that's not the
Sir,
case.
that is why this provision has been introduced. I think government does that.
Anyway, I have my own reservation. Okay, 233 we have already discussed. Couple of more observations from my side, not more than that. Now, Pawanji, to begin with,
Sir, aap mute pe.
Okay, Narayan, 5 minutes for you.
Okay, quickly. Sorry. So first is, I think you've done what I wanted to tell is, Ankit, such a vast topic. It's amazing job you've done to encapsulate it in such a beautiful manner in a very condensed form. So compliments to you, Ankit.
I think it goes to Shivam, sir.
Shivam, sir. Shivam is the...
Shivam and Ankit both, you all have encapsulated it very nicely.
All
Two
team
of the
members of
points-
Mr. Pawan Kumar Vijay.
Of course, Madanji. So one or two points. One is like Ankit and Shivam, which you have mentioned about the additional director for 3 years. I thought it is a very good move of aligning it with LODR, because even at unlisted, there were two schools of thoughts, correct? One school, ADs can be regularized at AGM, regularization of AD at general meeting like EGM without waiting for next. Because here they were arguing 152 is paramount. Once it is said, it can be shareholders can be appointed in general meeting, it can be AGM or EGM. And this is irrespective of 161(1), where it says that additional director shall hold office up to the next AGM, correct? Because this school argues that section imposed a restriction on tenure and not procedure, correct? And there are other equally other school which says that you can't do it, correct? And I have seen even after regulation 17(1)(c), unlisted companies saying if listed companies can do it, we can also, unlisted should also be able to do it. And there were both ways people were doing it. And I thought this will bring immense clarity to the concept of additional director and their tenure, correct? Treasury stock, we've already spoken, correct? KMP resignation, Shivam and Ankit, you have touched it very nicely. Both, there are positive and negative side. Positive is when the company fails to intimate, said KMP may forward a copy of his resignation similar to the director. But negative downside is resignation takes effect from the date mentioned in the letter. This can only apply to a non-executive director. The whole purpose was non-executive, the moment the letter is given, it's okay. You cannot apply it to a KMP, correct? Because you got contractual agreements, you got you got a 3 months, 6 months notice period. And even if you see for listed entities, the Industry Standard Forum has clarified that the timeline of 24 hours for disclosure of resignation of KMP, that would start once the person has served the last day. So it is linked to the exit date. And now if you are going to say that it will, the KMP can resign from the date on which he makes a mention, I think there is some lacuna over here. We will have to represent, that will have to be removed. Today, companies are finding it difficult to even find a replacement of a CS, CFO within 3 months. And if you today allow on the same day, you'll create chaos. So I think probably this could be represented. Vacation of office, of course, as you are aware, Ankit, in 2018-17 Amendment Act, they had specifically provided that even if you incur disqualification, it will be other than the company in which default, because you don't want to keep that other company, defaulted company, at least you have to support, correct? But that is going to be reversed. Of course, you rightly pointed out of the 6 months, but yet I feel that provision which is reversed, that could probably be looked into. You touched upon fit and proper criteria under 164. So I think boards will have to now, the way you have criteria for independent directors and others, you will have to have a proper fit and proper criteria for directors. Boards will also have to evolve a policy for this. Okay. You also very nicely pointed out striking off of defunct companies. Ankit, here one point is this addition of non-happening of any significant accounting transaction in the preceding 2 years, correct, is very important. Because Ankit, you are linked it to 455. The key difference is 455, one is voluntary, and second, there they say if you have merely transaction for ROC fees, legal compliance, allotment, office maintenance, I'm not going to treat it as significant accounting transaction. So once it is coming as part of 248, then it becomes the functional test is activity versus inactivity. And today you don't have to, the regulator need not go to the office. By merely seeing the accounts, if saying there's no revenue, sale of goods, receipt, a transaction, or there are no financial transactions, a borrowing, investment, or capital transaction, or purchase side, asset side activity like purchase of property or entering into any contract, leasing arrangement. So this will be a fit and proper case for striking of the company. Companies will have to be really, really careful. All the arguments which they were doing with the auditors, correct? And of course, the regulatory intent is, of course, eliminating shell companies, Benami transactions. That is completely understood. But I thought shifting it to 258 are having other consequences, correct, which we need to. 2 or 3, that was the only comments in 5 minutes. Thank you. Thank you, Pawan.
Okay. Amit, closing your, then I have 12 questions.
Sir, I think we can take up the questions. I'll just have one point. I think rest everything has been captured by Shankar sir and Madan sir. I fail to understand the comeback of one provision, which is the bar on the adding notice of trust, the provision which was similar to 153 in the 1956 Act. Way back in 2000 amendment, 187C was amended, inserted, and the provision of beneficial ownership was brought in, which continues in the form of Section 89. Though this amendment was as per the recommendation of the Corporate Law Committee in the, I think, 2022, way back, and from there, I think they have continued, but I'm not at least able to understand as to what could be the logic of bringing this provision of creating a bar that there will be no notice of trust in the register of member. That's the only point I think. Rest all professors have already discussed in detail.
Okay. So now I'm just taking questions. Shivinder Chopra, they have written so many things. Anjali, no new point now. First questions. Many AIF are mentioning the income of investor is tax free. Is it correct? Manoj?
Sorry, AIF incomes are tax free. No, it is not. It is only the pass through.
Yeah.
In case it is a
Okay.
it a determinant trust, then whoever the beneficiaries, they will be taxed directly,
Okay.
and not the trust.
So,
That is
Shivinder Chopra, he has given so many suggestions. I think we will incorporate it in this. Next, the merging company and transferee company both are subsidiary of same foreign holding company. Can they go for fast track merger? I think there's no restriction of foreign company.
Yes, it can. Subject
can.
to being
And
subject
the
to being
interesting point is
solvent.
listed company can also go for now fast
Sorry?
track. Listed
Yes.
company.
Listed company, in case holding and subsidiary relationship is there and the transferee company is listed company, then it can go for fast track.
Okay. Under the guise of ease of doing business, criminalization of certain non-compliances, particularly non-compliance of the tribunal orders, making more and more vulnerable and paying way to more non-compliances, resulting contempt proceedings, mockery. Any comment, Ankit?
Madan sir is the right
Hey,
person dealing with
to be
NCLT.
very, very, I've not dealt with understood the question properly, but my comment on this fines versus penalties are.
No,
Okay.
sir, there they have removed the punishment and provided for contempt by if you are not complying with the order. Earlier there
Because,
was
as
some
far as
punishment.
contempt is concerned, even NCLT is not sure of how the contempt
Hmm.
proceedings are to be dealt with, to be very frank. Section 425 अभी तक NCLT के members को बहुतों को समझ नहीं आया है. I have no hesitation in saying this. Number two, ये जो fine और penalty के जो provisions आए हैं ना, I'm telling you the penalty provisions are too stringent. I mean, you're deciding a fixed penalty, 5 lakhs of rupees. Earlier, it was up to 5 lakhs of rupees. At least in case of up to 5 lakhs of rupees in fine, you can go for compounding. But now, in case of fixed penalty of 5 lakhs of rupees, ROC is imposing for petty offences. ROC is imposing lakhs and lakhs of rupees on the company as well and all the directors. Then you are going to the regional director, preferring an appeal. I mean, all this is going to is taking a lot of time, and the companies have to spend a lot of money. Individuals have to spend a lot of money. Now, here I'll say under the garb of ease of doing business, on the one hand, you are decriminalizing the offences. On the other hand, it's too much of a burden on the companies as well as on the individuals for petty offences.
Right. In such cases, only remedy would remain writ petition. So it will again.
But again, it is not an easy job. Go to High Court and file a
High
writ,
Court,
engage a senior.
Right. It is a very costly affair. Yes.
Yes.
And as Madan, you are telling 4210, as I was referring, it is up to they have removed. That means it is equivalent to what you have done of 2 crores.
That would
So,
be very challenging.
It's
And the difficulty what Shankar sir is saying, they are not making a distinction between what is covered in 4210, that is the default in relation to offer and acceptance of money, versus the minor clerical defect in the explanatory statement also, which is not the case of 4210. But
okay. So can double DIN problem be addressed now? as per this law, Ankit, due to AI users now doubled in obtained by directors is coming to the knowledge, there should be some way to deal with the without being big amount of penalty. But the now
I
double.
think already, Pawan sir, already now new DINs are not getting duplicate generated because PAN number is mandatory, right? Sufficient. These are those cases when in 2005, 2006, when the government came with the DIN where PAN was not mandatory.
Okay.
It was like either of the proof, like if you have a driving license, passport, or any ID proof was sufficient for the purpose of generating DIN. And later on, PAN was introduced. That's how peoples have created. I think new system is very difficult to bring in because it is popping up you and it will not generate the duplicate DIN.
Okay. Okay. Now there is a comments on this that we are creating system ecosystem for a startup MSME. Same thing he's suggesting. Hitesh is suggesting farmer producer company in a small town. People are not aware, and they do. I think for this Hitesh we require to suggest ministry because producer company concept has not taken a shape in India the way they were expecting. Our reason is compliance. That is number one. Second is non-clarity on the issue. Okay. So these were some questions. Friends, one more issue I want to raise before everyone. I was just reading this and after seeing this, there are so many professionally chartered accountant, company secretary and cost accountant. They are working on filing forms, form-based advisory, procedural certification, basic ROC, NCLT appearance. That was a bread butter. Now, by doing decriminalization, reduced filing, simplified process, automation of digital system, I think routine compliance work will reduce to around 30 to 40%. My judgment is right or wrong? Amit and Ankit.
So this law doesn't reduces too much filing. The filings are still continuing. No specific filing has been removed
No,
as of
filing mean
now.
overall, when filing will come when the law will be implemented, when they have already plugged the issue, then you will not file if you are.
But sir, with more companies now, with more and more punishments being shifted to penalties, and ROCs being more vigilant and levying huge penalties on adjudication and taking suo motu action, I think professionals will be more vigilant and there will be further scope of advising on these compliances.
Okay.
I think it's more about creating a specialization because you need to have a sufficient infrastructure, manpower, specialized professional who will be focusing only on the filing aspect because this will now have a significant impact, right? As Shankar sir was also mentioning that penalties are increased multi-time, right? And they are having less discretion. So companies, if want to buy the peace of mind, by doing a filing in a manner which does not cover any or impact any liability tomorrow. So they need to go to the professional firms who are expert in doing with that so that the surprises don't come. So I think that will develop as a separate vertical, and those who don't want to be into this, they can always remain into the solicitation and the other business and advisory. I think that will be the way forward. This amendment bill is making this distinction even more crystal clear with the use of AI. I think the tools will emerge which will help you in doing the automation, which was, I think, a bigger hassle in the previous regime in V2, where you were not able to take a feed from MCA portal for maintaining your data bank and database. I think those things will be coming forward with the forward integration, and lot of things will become automated.
Okay.
Pawan ji, on this adjudication, एक मेरा suggestion है that now ROC is adjudicating authority, additional registrar is adjudicating authority, joint registrar is adjudicating authority. The title is adjudicating authority. Are they adjudicating it? They are simply calculating the amount of penalty. They should adjudicate it. Day before yesterday, I was reading a case, adjudication order. Company suo motu has gone to ROCs. I have done this non-compliance. RO is simply calculate the amount of penalty and levy the penalty on the company and its director. I mean, some sort of discretionary power should be given to the adjudicating authority. They should be actually adjudicate the case on merits.
The adjudication has been restricted to determine whether the offense is there or not.
That's all.
Once the offense is there, the amount of penalty is not the adjudication.
Actually, that should be adjudicated.
But I think they are mentally prepared, and that's how the foreign developed nations have worked up around. And all across the globe, if you see, the discretions are reduced, and India is also following the same. I think that trend is going to continue. Government is not in a mood to give any discretion to any officer.
Okay, that's simple. You have seen the traffic challan. You have violated. He will tell payment is done. The matter is over. Now, why you are giving, if I have violated 2 days late filing, something I have missed out, why you are giving me offer, I should come, do this, file this, all these things create burden on the system. So you have reduced this burden since 2007 by introducing MC 21, even if because number has increased. So things are there. So it is better you focus on the larger issue, not the small issues, where the penalty you pay, matter is over, it is not affecting anything. And I was in IICA on the next on Monday. I was talking to Ganeshwar sir. They are also working out, and I'm in some committee on this. Time has come when, in place of talking a small company or the startup and other thing, we should demarcate 3 categories. Simple. First is the direct public interest. That is a listed company and anybody is taking public deposit. More compliances. Second is you have taken indirect public interest is there in the company, like you have taken bank loan. You have taken loan from some company which has taken loan from other bank. That is there. This is indirect, because if you fail, that particular person will not, the bank will also get disturbed. And if Amit has given money to me, Amit has taken money from the bank, then it will also be disturbed. Now, third category, which is husband-wife company, so small company which is not taking anybody's loan, which has no connection with anyone. Why you are asking all these information? They have tried here. There are 3 category and everything. What is the need to give a startup? What is the need to give any concession to MSME? If you have taken loan, you are here. If you're not taking loan, you are there. But if you are in public company, you follow. So public company having low list public money, or you have taken money from deposits directly, it should be strong compliances. Rest of the thing, I think we should now work on this, not giving relaxation to multiple companies. One single form you do, no audit, nothing else, no certificate, because they are not disturbing your system. They are doing work and taking advantage that, okay, perpetual succession there, why you require everything. So this is my, and I want to give this suggestion to everywhere now, that you must do this. So friends, it's a time to close now, and I just want to take 30 seconds from everyone. Comment on this, what will be the impact, and we will do again this type of program. But I'm starting with the senior most, Narayan Shankar.
No, nothing much. We've covered everything, Pawan. And of course, there are many improvement areas, and including alignment with other laws like SEBI and others, where I think, since it is now, like you rightly mentioned in the starting, it is now referred to a JPC. And in fact, the finance minister has suo moto referred it to JPC, and the process will start. So, as part of the process, I think we should appeal to everybody to take this window and ensure that you all, wherever we possible, with our expertise, we could contribute in aligning laws. It will be a great for industry and professionals alike.
GP.
Pawan. Sorry, good. Yeah.
GP.
Okay, one suggestion on the bill itself, another comment. Suggestion is that with respect to one board meeting for small companies. On the one hand, you are increasing the limit of the threshold limit of small companies to 100 crores to 200 crores of turnover. And on the other hand, you are saying the company shall be, it will be fine if the company holds just one board meeting in 1 year. I think the majority is going to suppress the minority now. If I'm holding 25% shares in the company, the majority may not hold any board meeting and do whatever it wants to do. And I'll be reduced to zero, I'll be crushed to zero, because it's on the basis of my practical experience in NCLT is also of the view let majority do whatever this wants to do. Under 241, 242, it is being said then let the majority is permitted to do anything, whatever they want to do. So that way, I think this is against the simpliciter provisions of 241, 242. And another, as far as the bill is concerned, no doubt the bill talks about more and more compliances, more and more governance provisions. But the genesis of this bill seems to be that so many unethical and immoral practices are on, and the government is seized of all those practices. And on the basis of the feedback, maybe they may be aberrations or they are in operation, I don't know. But that seems to be the basis of this particular amendment bill. Thank you.
Okay. Okay, Manoj.
Overall, I think theme is to reduce, to make it ease of doing business, but practically बहुत ज़्यादा change नहीं आया. Practically, there will be not much difference in the ease of doing business. But with respect to merger and amalgamation, I think certain very important amendments have been made, and that would make life easier for professional and many internal restructuring plans, which are getting maybe pre-IPO stage and etc. Internal restructuring, it will be very helpful. So that's a good thing.
Okay. Amit.
So I see this corporate law amendment bill as a direction. That is if somebody wants to read what is the changing dynamics, what is the thought process of the government, which is undergoing in their mind. I think somewhere the government is very conscious that it's a opportunity that they can encash on in the geopolitical situation where the country is sitting into today. And considering that, government has tried to make tweaking in the provision to give a direction. I agree that many of the things could have been done in much better manner and many of the new provisions could be inserted. I completely agree. But I can see the spirit behind is certainly that government wants to be prepared with the infrastructure so that we can catch on the opportunity what is coming forward. I think many more changes will come in place in times to come. But as a beginning, I think this is a very good move.
Okay. Anjali.
Just a small suggestion, sir, that some of the changes will have to be brought in tandem with SEBI as well. For example, buyback regulations, SEBI buyback regulations even presently talk about only one buyback in a year. No second buyback is allowed after till a gap of 1
I
year.
think after the changes in the Companies Act, they will.
Maybe, yes, of
maybe
course.
they-
Sir, but if SEBI
Yeah.
bars, then it will overrule definitely.
Okay. Mohini.
Secondly, okay.
Yeah, Anjali.
Second point is with regard to the EGM's notice of 7 days. Herein again, SEBI will have to be taken into loop because even just the way in preferential allotment, we have to do the allotment within a period of 15 days from shareholders' approval or regulatory approval. 7 days, that's for sure that we'll not be getting the in-principle approval. In-principle approval 30-35 days mein hi aata hai. So for that, both the regulators will have to act in tandem with each other. That's
Again,
it.
provision says as may be prescribed. MCMS is not applicable to listed companies.
Not applicable to listed companies.
It
Quite
can very well
possible.
say.
Yes.
Okay. Mohini.
So recognizing the RSUs or SAR or any other instruments for the employee benefit is a good move because but only the clarity will comes when the actual rules will come that how easily now in the unlisted space we be able to do it. The final comments can be given only once the rules are clear.
Okay. So last Ankit, our hero of Companies Act.
Sir, I think there are a lot of good moves in the amendment bill. Some things which we were wanting to have it since long. So I believe they have found their place, but lot of things which still should have been there, but there are no provisions with respect to any liberalization of raising of funds under even private placement or 62. I think lot can be done there. Specifically in respect of conversion of loans and other things, there are still a lot of issues which are unresolved. Regulators are taking a different view. Rights issue where renunciation has been used as a tool to bypass private placement. So a lot of things are there where still some tightening is required. I think we can use the JPC to set forth our views on that and
Yeah.
try to bring that kind of a change. But definitely, I think a lot of positive moves in the act. There is no doubt.
So what we'll do, we will compile all suggestions today, what we have discussed, and then we will move a survey also from this and get the view and submit to the Parliament committee. So they will take and they will understand. And absolutely right, Ankit, my suggestion which I have given, 3 type of company that we should promote and we should ask them government in place of talking and giving relaxation to all new things. Friends, Shivam
पवन
is
जी आज को मेरा एक सजेशन है आज
एक
का
मिनट बता, एक मिनट. Shivam is here. All presentation and research and analysis of this
Excellent.
and sending work to the. So 3 cheers for
Absolutely.
Shivam.
Shivam, excellent.
Yeah.
The manner in which you are able to encapsulate it in such a beautiful, condensed manner. It's a live lesson for management by exception, if you really are.
yes.
Yeah, Madan.
What I was saying today was a capsule program. I think आपको you should have at least 4 or 5 other webinars on the इसको compartmentalization करके
Yeah.
on that should be done because we should discuss in detail.
Yeah.
There are many provisions which require detailed discussion and detailed suggestions to be given to the government, particularly to
Sure.
the JPC now.
Sure. We will do it. We will do it specifically on this. Okay. So friends, now it's a time to close. And as you are aware that our journey of knowledge sharing is continuously going on. And third is the Good Friday. So we are taking leave from this hectic schedule of every week webinars. So on 10th, we will have the session. And this one, we are taking a very interesting and new session of she box. And that is a concept of POSH related thing. And Madan sir is expert in this subject. So we will take up this and we will come out with so many new things related to this. Till then, thank you very much. Good night.
Cheers.
Thank you.
Yes.